All right, today we're going to deconstruct a professional-grade trading blueprint, and we're focusing on one specific opportunity, Itochu Corporation. We're not just going to look at what to do. We're going to break down the why behind this trade, and more importantly, how to execute it, piece by piece. So let's get right to the point. The core idea here is that Itochu looks like a high-conviction buy, but honestly, the most important part of that sentence is the second half, clearly defined risk-reward parameters. You see, that's what separates a professional plan from just a random guess.
Here's our game plan for this session. First, we'll cover the why. What makes this a high-conviction opportunity? Then we'll get into the mechanics, the entry plan, your stop loss to protect your capital, the exit strategy to lock in profits, and finally, the rules of the road for sizing and discipline.
Okay, let's start at the beginning. Before we even think about hitting the buy button, we need to really understand why this opportunity is on the radar. This isn't about chasing momentum, it's about seeing a bunch of positive factors all lining up at the same time.
So let's look at the evidence. The analysis gives this a strong buy rating, and a big reason for that is a massive valuation discount. We're talking over 50%. On top of that, you've got strong momentum, a stock split coming up, which is a huge catalyst, a solid rating from Zacks, and an absolutely exceptional risk-to-reward ratio of 3.7 to 1. That's a powerful combination.
So we've established the why. Now let's dive into the how. Look, professionals almost never go all in at one single price. It's just not done. Instead, they scale in, building their position piece by piece. It's all about managing risk and getting a better average price. This chart right here, this is our roadmap. It lays out the entire plan visually. You can see the 3 different entry points, you can see that hard stop loss, and you've got the 4 different targets for taking profits. Let's break down exactly what each of these levels means. The strategy here is all about being methodical. With Tier 1, you're putting 50% of your capital to work right away to catch the current momentum. Now, if the stock pulls back to around $115, that's a key support level. Tier 2 adds another 30%, and if we get a deeper correction down to 108, that's our maximum value zone, and where we'd put the last 20% to work. The whole point is to get a great average entry price. All right, let's talk about what is, without a doubt, the most important part of any trading plan. You can have the best offense in the world, but if you don't have a great defense, you're going to lose. A trader's #1 job is capital preservation, and that's exactly what a stop loss is for. For this entire plan, the primary stop loss is $110, period. From that first entry, this represents a maximum risk of 8.3%. And let me be clear, this isn't a suggestion. It's a line in the sand. We call this a hard stop, and it is absolutely non-negotiable. Why that specific price? Well, a close below 110 would break a key support level, and that would tell us that our original idea for the trade might be wrong. And at that point, we don't hope, we don't wait, we get out. Now, risk is a personal thing, right? While our main recommendation is $110 because it strikes a good balance, you can adjust it. A more conservative trader might want a tighter stop, maybe at 115. A more aggressive trader who can stomach a bigger swing might set it at 105. The key, though, is you have to pick your level before you get in, and you have to stick to it. Okay, we've managed our risk. Now let's get to the fun part, taking profits. But just like our entry, our exit strategy has to be systematic. We don't want emotions like greed or fear making our decisions. We have a plan, and we're going to execute it. So we're not just going to sell everything at one price. The exit is broken into 4 stages. First, we take a quick profit just to de-risk the trade. Second, we capture the main part of the move we're expecting. Third, we hold a piece for a potential re-rating of the whole sector. That's a big picture move. And finally, we leave a small runner just in case this thing really takes off. It's a structured way to take money off the table. And here are the exact numbers. At $126, a nice 5% gain, the plan is to sell 25% of the position. At $138, that's a 15% gain. We sell the biggest chunk, 40%. At $155, we're looking at an almost 30% gain, and we take another 25% off. And that last 10%, we let it ride, hoping for that full target of nearly 50% upside. Every exit is planned in advance. And this plan isn't just based on chart levels. It's tied to a real-world timeline. The analysis expects people to be positioning themselves before the stock split, which happens in early January. That could be the fuel to hit our first couple of profit targets. After that, earnings season comes around, and that could be the next catalyst to push us toward that third target in the spring. We've now reached the final, and I would argue the most critical section. You can have the best plan in the world, the most perfect chart, but it is absolutely worthless without proper position sizing and ironclad discipline. This, right here, is where most traders fail. So how much should you actually invest? Well, let's use a hypothetical $100,000 portfolio as an example. A conservative trader might put in 20 grand, risking about 1.7% of their total portfolio. Someone with a moderate risk profile might go with 35,000. An aggressive trader could even go up to 50,000. The key principle here is you have to decide how much risk you're willing to take before you ever place the trade. Now for the rules of engagement. Rule number 1 is simple and it is brutal. If the stock hits your stop loss, you exit immediately. No questions asked, no second guessing. You take the small loss and you preserve your capital to fight another day. And rule number 2 is just the flip side of that same coin. If the stock hits one of your profit targets, you sell that part of your position immediately. Greed will destroy a trading account faster than anything. A pro sticks to the plan they made when they were calm and objective. And this one is about psychology. We've all done it, right? The trade goes against you and you think, I'll just give it one more day to turn around. No, you can't do that. The market does not care about your hopes. When your level is hit, whether it's a stop loss or profit target, the decision is already made. Your only job is to execute. And here's the final rule that ties it all together. You must preset every single one of your levels, your entries, your stop, your profit targets, before you risk a single dollar. You have to make these decisions when you're calm and analytical, not when you're in the heat of the moment with money on the line. So to bring this all home, let's recap the action plan. The blueprint calls for an initial entry for Tier 1 with that non-negotiable hard stop loss set at $110. Your first profit target is at $126, and you stay ready to scale in on any weakness at those predefined lower levels if you get the chance. And that really leaves us with one final critical question. When you have a plan this detailed, where every variable is accounted for, from your entry to your exit, from your risk to your reward, the plan itself is no longer the hard part. The only variable left is you. Do you have the discipline to actually execute it? That's the real test.